Eddie, we got Candace on the line. What do you want to ask her?
How did he go about, acquiring those skills or that knowledge to make sure that 17 deals later or however many deals later, you are successful?
So you can read all the books and listen to all the podcasts and go to all the conferences in the world, but until you actually do it, you're not going to ever feel like you have a grasp on what goes into it knowledge-wise.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and aspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. It's not very often that I have two repeat guests on the show, but that's what we have today. We got Candace Pilgrim as our experienced investor. She was a guest on episode 55 way back in November of 2020. And we got Eddie Esparza, who's a more recent guest, asked to come on again as an aspiring investor. And so, of course, I said yes. You can hear him earlier on episode 416 from May 12th. But that said, guys, welcome to the show today.
Thank you, Brian. Glad to be here.
Glad to be back as well.
Awesome. Well, I think everybody knows how we do things. Experienced investor comes up first. So Candace, tell us a little bit about yourself.
Yeah, sure thing. So I guess I could go on forever probably because I've done so many different things that are unrelated and taken a lot of different paths. But I'll start with 2012, I guess, is when my husband and I jumped into business. We launched an electronics wholesale company in 2012. We were really the only company of its kind in Alabama at that point in time. So we did really well. We were able to operate with some healthy profit margins for a while. Which fast forward to 2016, by that point in time, we had amassed a pretty good bit of capital that we no longer needed to reinvest into that electronics business. Having that capital just sitting in the stock market is what really got me thinking about what other investment vehicles could I entertain that would be a little bit more tangible than the stock market.
Yeah.
I'm a very type A personality, so I wanted more control over my investment than just the stock, set it and forget it type thing. So started reading books on, different asset classes with real estate and trying to figure out what I wanted to do there. So first I did a few single family rentals first, the BRRRR strategy, for those of you who are familiar there. I just realized I couldn't scale fast enough. So it would have taken, I would have had to have like 100 houses to get where I needed to be there. So it would have taken way too much time one by one. So landed on multifamily, long story short, started going to conferences, really just learning about the space, immersing myself into that world and networking with experienced operators and passively investing with experienced operators, learning more in that way. That's what led me to multifamily. So we're 2018 by this point, and that's eventually somewhere in 2018, I quickly went from passive to active. By early 2019, I was jumping in the active space, pursuing deals as lead operator.
Awesome. Now, right now you're with Astra Capital and a whole bunch of really good people that I know fairly well. When did that come about along in the journey, and how has that developed?
And so Astra Equity, I have 3 business partners in Astra Equity. The 4 of us met in 2020. We started joint venturing deals together first. So back, I'll go back to my background a little bit, I guess. In 2019, my husband and I were doing everything ourselves first. We were just buying deals on our own. We joint ventured with a few friends on one deal. And then I met the Astra guys. We started joint venturing together, just our 4 companies, joint venturing on the deal together. And after the 3rd deal, we just knew it was right. Like, we worked so well together. We had so much fun together. It just worked. So after the 3rd deal, we formed Astra Equity. So even though we had done a few deals together, we weren't officially Astra Equity until January 1st of 2021, I think is when we had made that announcement.
Now, talk about the thought process. Doing JVs, I think a lot of people start with JVs. How did that evolve from JV? How did those conversations go? From JV to, hey guys, let's just form a company and do this full time together?
Yeah, I mean, I think the good thing about JVs first is that you really get to feel out what it's like to work with someone day to day.
Mhm.
Because regardless of how many conversations you have up front and how great it seems and how you seem to align vision and all that, you
Yeah.
just really don't know if you're going to work well together until you do it, inside and out on a deal, bring a deal through the business plan together and make sure it works. So that's what was so important to us.
Yeah.
Also, another thing, I know, a lot of partners may be in very different places financially, and that's not the case for that. So myself, as well as the 3 Astra partners, we're all very similar in terms of balance sheet, net worth, liquidity. We all had a similar amount of liquidity when we started. So that made it very easy to go from that JV model where we were all putting in whatever amount of capital we felt comfortable. Obviously, we'd own our pro rata share, to more of a exclusive working together as Astra Equity. And now in every deal we put in equal capital. Whoever has the least amount they want to put in, that's what the other 3 put in. But we all have some financial strength there to be able to do that.
I love it. I like that idea. So, and it is, when I started out, we had one person that had the bulk of the net worth and everything else. And occasionally we'd refer to him as the bank. And I know that's probably not the best way to look at it, but I think that's a great way to start, where everybody's almost on equal footing. So now, you say when you started, it was JV, it was everybody putting in money and doing deals. Have you started doing syndications as well? And when did you guys start doing those?
We have. So when we started, we were more of like an investment club, if you want to consider it that. We all had money to invest.
Yep.
Just chose to do it together. In the JV, we all put in our own money. We didn't partner with anyone at first.
Mhm.
Then we started JVing with a couple of other friends and family that wanted to work with us. Then from there, we transitioned into syndication. So, like everyone else, we learned we're never going to scale and buy, the larger complexes. Eventually, everyone runs out of money regardless.
Yep.
Capital events, refis, all that's great. But
Mhm.
to really scale, you have to
Yeah.
take advantage of that syndication model. So yes, we are syndicating now.
Yeah, I mean, you're putting money into it, and even when you syndicate, sometimes it's hard. It's what I found several times over. You have money out at EMD, you have skin in the game on everything, and eventually you are going to run out of money. So, but yeah, awesome. So let's switch gears a little bit and let's talk about one of the projects you guys have done. Pick your favorite, or whichever one you want to talk about, and tell us a little bit about it.
Yeah, so I think what might be best, especially for the listeners, would be to talk about the very first deal that I did, because it might resonate more with those that are newer to the business, maybe, aspiring investors specifically. Now, this deal was my husband and I only. I was not a member of Astra Equity yet. Would have been much easier if I was a member of Astra Equity at that time.
Right.
But it was a heavily distressed deal. We took over and had to bring it down to 50% occupancy, which was not for the faint of heart. Really was not a good deal for beginners, and I was definitely a beginner at that time. Yeah. So I learned so much from that deal, and I just think that not only let me know my strengths and weaknesses to know what I could contribute to a partnership like Astra, but it also helped me understand what I like and what I don't like what I don't want to do on the next deal. Another partner can take on that role because it's just not for me. So I learned all of that, in addition to really just making so many mistakes that helped me, because this deal was, with it being a heavy reposition, there was a lot more room for the mistakes, a heavy rehab budget, just a lot of time intensive, but it helped me learn, the systems I need to put in place for the next one, and helped me get a little bit better. Now, each deal did that. Obviously, each deal I did made me a little bit better for the next one, but especially that very first deal, I felt like was just kind of like a domino effect to allow more closings and more success after that.
I think a lot of people will say the same thing. I mean, that first deal is always a big learning experience, a big challenge. And I think you're right. Every deal you do, you learn something new from it, and you grow a little bit more. We're doing our first life insurance company loan right now, and that's kind of a new experience too. Which, 15 deals in, one life insurance company loan, so it's all kinds of fun. Brand new process, working with a different type of lender. But well, cool. So let's talk a little bit more about motivational aspects, things that keep you going. It's what I like to call your why, or your big burning why. So, Candace, what is your why?
I'm sure you get this
Mm-hmm.
response quite often of, time freedom and financial freedom. And that is true for me as well. But we already had a little bit of that with the other business. I think for me, this was more about multifamily. Unlike the other business I was in, it's a lot easier to put the right people in the right seats in this business and eventually allow it to be more passive. It's never going to be 100% passive unless I passively invest, which is not what I want to do.
Right.
Because I like doing the active side. But at least for me, it allows me the time freedom now to where I can take vacations whenever I want. We just got back from Aruba, and a month ago we were in Canada. I can do this from anywhere.
Yeah.
I'm the asset manager for our team, and I can asset manage from anywhere. I'm always checking figures and talking to property management, but it's easy to do that while traveling. It's easy to make my own schedules. And of course the passive income is great as well.
Yeah. It's awesome. I love it. I love it. That's terrible. I mean, Aruba and Canada, all in this, gosh. I mean, what are we going to do? But anyway, last question for you, and then we'll bring Eddie on. But what's next?
So Astra is really putting a focus now on scaling up in property size. We've really played a lot in the sub 100 unit space. We've kind of mastered that locally here in Alabama with our property management partnership, to where we can manage those well, and we've done great with them. But like everyone else, we really want to acquire more of the 100, 200 unit properties. So to do that, we know that we need to make some strategic co-GP relationships. So we're really turning our focus to that now, and identifying who we might want to co-GP with to scale up to the next level here in the Alabama market. So that's what I would say is next for Astra. Also considered a fund. So there's been a lot of talks with a small to mid-size multifamily Alabama specific real estate fund. That might be in the cards. Not sure exactly when yet. So that's it. I would say those are probably the two biggest what's next things for Astra.
Sounds exciting. Sounds exciting. I think that's the next step for a lot of people. A lot of people start thinking about, hey, what about funds? It makes doing capital raises for specific properties, kind of gets old. It's it would be nicer if you just had, raise money, put it in there, pull it out when you need it. But that's next on our radar too. But anyway, shifting gears, Eddie, how's it going, man?
Everything's going well. How are you doing?
Doing great. So tell us about yourself, man.
Yeah, definitely. So name is Eddie, born and raised here in Chicago. And, as far as real estate goes, I'd say I was, kind of born into it. Actually, just found this out a few years back when my parents, found out that they had me. That was actually the day that my dad decided to go buy, fourplex. And then so I always kind of just grew up around my father, just, being the handyman, being the PM, being the landlord, being everything. Obviously, when I got older, helping him around the properties, if we needed to put up some drywall, or we needed to, swap out some pipes. I was always, in for helping, right? Fast forward a couple years, and then just, being able to see how much time he put in, I kind of took a step back as far as, like real estate kind of turned me off for, I say, a couple years when I was around, high school. I mean, at that time, you just want to be with your friends, right?
Yeah.
Over time, I started to see the power of real estate. Obviously growing up in not the greatest area in Chicago, up to now where we are now, just through the power of real estate. The appreciation, obviously investing in more properties, helping him kind of scale, right? And then, I ultimately decided to just kind of go ahead and jump in as well. So this was around 2018 actually. And just kind of, did a little bit of digging, certain areas here in Chicago, right? Certain costs, and just learning through, helping my father. So then Dive into the first one. It's a threeplex, and then it's a foreclosure property,
Mhm.
and had a budget, had a timeline, everything was gonna go great. Helped out multiple times. Everything is peachy, right? Quite the opposite.
Mhm.
Over timeline, over budget, things that I didn't really consider kind of came up. But I always kind of take a look at things, glass half full. In the end, everything came out, more than, well, actually better than I expected.
Mhm.
There is really appreciating a lot of development here, in that particular property. But the main takeaways for me were just, understanding, the in and outs, right?
Mhm.
Understanding what we need to account for, understanding that, hey, nothing's going to go according to your timeline or your plans, right? Especially dealing with, contractors, having to vet them,
Mhm.
um, and all that good stuff. Also, leasing tenants, some of the times when you get the great ones, you're, truly excited. Sometimes you don't get those great ones, right?
Yeah.
So you need to learn how to manage them.
Yeah.
Then came about the COVID. And then that time, we kind of see, we went quickly from a time where we thought that the world was going to end, and then everything
Yeah.
started quickly appreciating, going up in prices. And I kind of just, thought to myself, I took another step back and told myself that this isn't gonna, hold true, right? This isn't sustainable. So I kind of just bowed out a little bit, started self-reflecting, kind of finding myself and what my passions truly were.
Mhm.
A lot of the hurdles here in, smaller multifamily, single family, right? I think we touched on multiple times, is just the scale, like scaling. You have to take on so many projects to get to a point where you're, receiving the amount of money, through that passive income, right? So that's when I started stumbling across multifamily. Intrigued me, started diving in podcasts, books, ebooks, YouTube videos, pretty much just, information overload, just taking all of it in. And, now that we're kind of seeing, multiple corrections, right? And with
Mhm.
the Fed also raising rates, right? Kind of anticipate some softening in prices, and hopefully there's a much better entry than what we're seeing, because there's still some gaps there. But now, part of a team, we're taking a look at the number of different deals. I say at least 5 on average a week,
Mhm.
fully underwriting, being, engaged with brokers on a day in and day out basis. So um, pretty much just understanding the things that I didn't want to do, or were, I say, the less interesting for me. Obviously being the PM, handling the
Mhm.
leasing, being that maintenance person, right? To just wearing hats on the other end.
Yeah. Awesome. Awesome. So, I mean, you've gone through a lot on your way to where you're at right now. And, I think a lot of people, have similar reasons for doing what we're doing. But, speaking of that, what's your motivation? What's your why for doing all of this?
Yeah, my why is, just growing up, seeing a lot of sacrifice that my parents had
Mhm.
to make for us, for my brother and I. Seeing that sacrifice, and family is huge, right, for me.
Mhm.
So being able to kind of give back, being able to say, hey, you don't have to, we don't have to worry about this right now. Like, the obviously the passive income, getting the financial freedom, being there to just spend more time, and then also just setting up future family, for the best in the future, right? So setting them up for success.
Yeah. Awesome. Awesome. Well, here comes the part where, we try to, help you as much as we can. So, Eddie, we got Candace on the line. What do you want to ask her?
Yeah, I have a couple questions for you. Yeah, just a couple. The first one that I have for you is, what has been the biggest challenge that you faced transitioning over to multifamily and investing in that space?
Biggest challenge I faced, let me think. I think the hardest thing for me, and it probably did not reflect in everything I said earlier, but the hardest thing for
Mhm.
me was really finding and trusting the right partners. Whenever I mentioned my first deal earlier, I didn't mention the deal before that, which I guess technically was my first deal, but it was a JV where I was really more passive than active anyways, but those were the wrong partners and I had a really bad experience. I don't even count it as a deal anymore. I don't even count it in my unit experience, any of it. But that one, it really kind of scarred me from not wanting to trust other people and just really wanting to do it all myself, and then the Astra partnership just kind of formed organically. I wasn't even looking for partners at that point in time. I knew there were the things I didn't want to do or didn't like to do as well as others, roles wise, but I was very hesitant to go exclusive with certain partners. And you see, especially in the multifamily space, so many partnerships break up and just end badly. And so I was very hesitant and skeptical, and it's been kind of a challenge for me to think that this is going to be any different. But now that we have several years behind us, I'm totally comfortable now working with my partners, and I know that I'm in the right place and doing the right thing. So I'm glad that, I guess the summary to that is, I'm glad I was able to trust, but at the same time, be very cautious who you trust and make sure you do your due diligence on them and that you do several deals with them before going and announcing your partners and all of that, because I have seen a lot of partnerships just end badly. So
Yeah, I've seen it too. I would say for me, the biggest challenge was believing that I could do it. It is really it. I mean,
Yeah.
I remember reading Rich Dad Poor Dad in like 2004 timeframe. I mean, long time before I got into multifamily. And he talks about multifamily in his book. I remember thinking, man, I wish I could do that, and it took me another 15 years before I really figured out, oh my goodness, yeah, I can do this. So for me, it was believing in myself. And long before I started doing what I'm doing now, I briefly thought about it and thought, nope, can't do it.
I can relate to that too, Brian. Like even today, I still feel like sometimes, whether it's talking to a lender or a broker or being on a podcast like this, I still think, am I really an experienced investor? I don't know if I'm, and I'm like, well, 17 deals later, I think I'm experienced, but I still have that feeling of I'm not good enough to be recognized for whatever, or, I'm not as experienced as someone else or as good as someone else. So it is kind of hard to overcome that feeling sometimes as well.
I do wonder if I'm ever going to get out of that feeling of inadequacy phase. I mean, because it's the same thing. It's every time we put an LOI in, it's like there always is a little hesitancy. Can I really do this? Can I really raise that much money? Can I really put this thing together and make this work? But I tell myself to shut up and just do it. So yeah.
Well, it's comforting to hear that you guys in the stage that you guys are in having those same kind of questions. So I guess, that just kind of confirms that I'm doing something right.
Yeah. I mean, there are lots of inadequacy feelings on the inside. And like I said, every phase, every time I do something new, every time I, put myself out there, it's the same.
Awesome.
Yeah.
Segueing to the next question here around, knowledge, right? The skills, making sure that you possess those, right? And that you feel like this is something that, with your guys' track record, right? Obviously you can, but how did he go about, acquiring those skills or that knowledge to make sure that 17 deals later or however many deals later, you are successful?
Question.
So you can read all the books and listen to all the podcasts and go to all the conferences in the world, but until you actually do it, you're not going to ever feel like you have a grasp on what goes into it knowledge-wise, at least for me. So like I said, that first deal really taught me a lot, gave me a little more confidence for the next one. And that next deal taught me a little bit more and gave me a little more confidence for the next one. But there's still always that learning component to every deal that I could never get from any media out there or conferences or conversations. So really just action, you hear all the time, like just taking action is most important. And it's super true. You have to actually get out there hands-on and learn by doing. And I think for me also, what was really helpful early on in the early deals, I had an unofficial mentor. It's not like someone I paid, and it was more just like someone I had passively invested with that helped me out to make sure, looked over my underwriting to make sure I wasn't making a mistake and I could ask questions. So I think that's important as well. It's just kind of finding someone you can lean on for the earlier deals to give you more confidence that you're not making a big mistake somewhere.
Yeah. learning by doing is by far the best way to do it, but I've always favored mentorships. It took me a long time to, get to the point to where I would pay somebody for advice, but I think what really happened is, I was looking for that informal mentor that could help me for free. Right. And oh, by the way, there's not many of those out there, but it finally came down to a timing issue. I had a certain timeline with my goals, and it was just like, all right, if I'm going to hit that timeline, I need help. And I don't have time to find somebody who's nice enough to do it for free. But, after that first coaching experience, I've actually paid for a lot of different coaches in different aspects, and just brought another coach along online, last week. So third different coach this year. So I lean towards coaching to help me get to the next level. And, like I said, a lot of it is driven sometimes by feelings of inadequacy. I sometimes think those feelings are kind of pointing out the areas that I'm weak at. And so I tend to bolster those up with coaching.
I'm definitely all for
Mhm.
paid mentorships as well. I think I was fortunate in that, I had invested a pretty good bit of money with this
Yep.
unofficial mentor I had that I guess kind of allowed me to have that unofficial mentor relationship. I would have happily paid if he had asked, but I think he was
Yeah.
grateful that I had invested. But yeah, definitely find someone
Yeah.
that can help you in those early deals.
Awesome.
The more and more that I kind of dig in, as far as just reading and podcasts, the more common I found that it is for, highly effective people and highly successful people to pay for these mentorships or coaching. I think on the opposite end of that coin, right? I found that a lot of people are like, why are you paying for something like that, right? But they are in that situation because they're not making themselves feel comfortable or reaching for, the stars, right? So that just kind of solidifies a lot of what I've been, hearing and reading.
Yeah, I think willing to pay for coaching or willing to pay for anything that will change your life, it shows your personality. Not, I guess personality isn't the right word, but it shows that you are that highly motivated to make a change or to take action. If you're willing to pay for the help, then you're a lot more likely to take the action and to be successful than someone who says, well, I'm not paying for that, because they're the ones that's never going to do anything. So I see what you're saying there. It's a good point.
Following on in that one, I mean, if you're not willing to pay for somebody's time, it's also kind of a sign of disrespect as well. If you're trying to like leech off of somebody, that's not a good thing, right? But yeah, I think not being willing to pay is in a way disrespectful. Anyway, back to you, Eddie.
Yeah, more questions here. How has the pandemic invested the way that you source deals or pinpoint them, and then also as well as like, the asset management strategies?
Yeah, so we had a brief slowdown, I guess, in 2020 when the pandemic hit. I mean, obviously everything was closed down for a while. So we had one acquisition that closed April of 2020, right in the middle of everything. We were literally doing our unit walks like the day before everything shut down. So that was kind of crazy. But then, there wasn't really much deal flow for several months. Once everything picked back up, we kept trucking along. I mean, we never really paused acquisitions. I know a lot of groups were kind of watching and waiting, and we were watching. We've always underwritten in a conservative manner. Everyone says that, but
Yeah, of course.
we didn't change much in terms of how we underwrote deals or how we purchased deals. We kind of stuck to our criteria for the most part there. Now, I will say now, fast forward to today, to me, the economic conditions now have affected things much more than the pandemic in 2020, at least other than that brief couple of months where everything was crazy and shut down. You may say it's caused by the pandemic, caused by all the the money put into the system and the inflation, but today with interest rates as high as they are, plus property taxes skyrocketing, plus everything that's crazy in the insurance world. And we've had some insurance premiums go up 50 to 100% year over year. Those three, triple whammy type situation that we're experiencing has caused us to pull back a little bit, and really just make sure that we're being extra selective on the deals that we buy. Obviously, if a deal works at 7% interest, it's going to be a great deal in a few years when interest rates come down. But other than that, we're just being really careful with the expense side and making sure we put higher expense escalators on property taxes and insurance, and we've tweaked our underwriting a little bit for that, but more so in 2023 than in 2020 when the pandemic hit, which is interesting.
Yeah, I agree. I agree. I mean, going through the pandemic, I was still brand new in the business, but like Candace said, there was probably a 3-month period where everybody was just, I mean, lenders, kind of stopped lending, and we weren't sure where the federal government was going to go with certain things. But once we realized that it was game on again, it was game on. And I think those were really good years. But yeah, Candace, I really like what you said about if you can make something work right now, it's going to work even better when rates come down. And that's my philosophy right now too. If we can make deals work with, I like loan assumptions. We've done a couple of loan assumptions this year, but if we can make loans work with current day interest rates, man, 2 years from now, assuming rates come down where you can refinance, and oh, by the way, when rates comes down, prices are going to go back up. But I think Candace is absolutely right. There's been much more of a disruption in the market or difficulties in the market in 23 than there was in 2020.
So hitting on that note there, how has this kind of affected, the type of, classes that you aim for, the type of returns? Brian, you mentioned like loan assumptions, right? What other kind of key indicators do you look for that if you're able to find that, you're like, this is what I need to get into, or at least, that first indicator?
Yeah, so one change for us, I think, related to that would be the vintage of the property. So we have a lot of 70s and 80s vintage properties in our portfolio right now. And while they've done well for us, they're our biggest challenge with insurance, because I'm not sure if this is true for everywhere, but at least in Alabama, several of the main insurance carriers suddenly this year for 2023 decided we're not going to write policies for 70s and 80s anymore. So then whenever we were up for renewal, they just non-renewed us. And they're like, what, we're pulling out of, that age range of property. So we've had to go back out to the market and seek other insurance. And we've had a lot of carriers deny to even quote because they're not interested in that age. Yeah. So all that being said, that age range of 70s to 80s has been a challenge on the insurance front. Not to mention that, obviously there's more surprises when it comes to repairs and maintenance and renovations and all that. So we're really now more than ever wanting to divert more to 90s and newer, more B plus type properties, 2000s properties. Those have been, our best performers anyway in our portfolio. And while the returns may seem a little lower for those type properties, I think over time, at least in the case of our portfolio, they're going to perform at least as well, if not even better than our 70s and 80s. So that's one change I would say is brought about by the insurance challenge of today.
It's not just Alabama, by the way. There's a lot of carriers that are, nationwide just not doing that. And like aluminum wiring is a big one. There's a lot of carriers that used to do it that are just not doing it now. The Federal Pacific, stab lock breakers, same thing. So there are a lot of carriers. I mean, just because of how many, $1 billion plus incidences in the last several years, a lot of carriers are just like, yep, we're not touching this. We're not touching that. So back to your question, Eddie, I would say one thing that I think, and I say this to my acquisitions guy all the time, first thing we're going to do is, before we even look at the numbers, is we're going to look at the property, we're going to look at the location, and we're going to ask ourselves, is this something we want to own for 20 years? Okay. And it's not a quantitative thing. It's more of a qualitative. It's like, do I like this location? Do I like the vintage? Do I like the style? Do I like this property enough that we want to own it for 20 years? And if it's a yes, we'll underwrite it. If it's a no or a very, we're not going to touch it. It's kind of how we look at it. So, it does reduce the amount of deals that come across our desk, but at the same time, just kind of like Candace said, a lot of people start out with, whatever is available to them as newer syndicators. And, oh, by the way, the things that are available to the newer syndicators are the things that the more experienced syndicators don't want to touch anymore. Right. And people start migrating towards the nicer properties, the 80s and newer, let's not deal with insurance or aluminum wiring or asbestos or lead paint or any of that stuff anymore. And so I think most people, I've seen this trend over and over again. Yeah, most people kind of have that same progression in their business.
Yeah, and area too. So vintage and area, like you were saying. We may have a deal come across our desk that's in a C area, and it's a great price. The returns look great. Yeah, but do we really want to deal with the headache? I mean, when you come to a point where, like you said, with more experience, you want to own nicer assets that are lower headache. And even if returns might have the potential to be lower, it usually migrates in that direction.
And you can only handle a couple of headaches in your portfolio. That's it.
Yeah, you'll get burnt out quick too if you have too many of those headaches. So.
Yeah. All right, Eddie, we got time for one more. So if we got one, let's go.
Given where you guys are right now, and through all the experience and deals that you guys have gone through, what would you consider to be the most important lesson you've learned, investing in multifamily?
Most important lesson. It's so hard to pick one. I would say to know your criteria and stick to it, and don't get caught up in all of the gurus, the conferences. They're great. You meet a lot of great people, but sometimes they preach a certain way you need to do things. Like, don't play in the small space, go 100 plus, go syndication, go with, they'll tell you certain ways to do things. And I think you have to know, like, introspection, like what's important to you, what are your goals, and how can you best achieve them? Maybe that means buying 20-unit properties, or maybe that means buying fourplexes. I just think it's important to know where you want to go and know the journey to get there, rather than just assuming. Now, I remember when I first bought that 40-unit property, that was my first deal. I was kind of like almost embarrassed about, like, it's not 100 plus. I didn't syndicate it, because I was told that I needed to do those things. And I'm sure we've made some of our best money in small deals versus if we had gone 100 plus and owned 1% of the deal with some other syndicator. So I just think that's one thing I've learned along the way, and I wish I knew earlier on, is that just know your criteria, stick to it, and don't get caught up in what everyone else is saying you should be doing.
Yeah, I agree wholeheartedly on that one. I would say on mine, people are more important than the places. Real estate is locational, but when you're looking at deals, when you're looking at partnerships, I do think the people are more important than the actual deal itself. I'm not saying do bad deals with good people, but if you had to, pick one over the other, you pick the people. All right. Well, we are pretty much out of time now. So one last question for each of you. And Candace, you get to go first. How can listeners learn more about you?
You can go to our website, which, if you have video on, I have at the bottom of my screen here, but it's Astra EQ as in equity. So astraeq.com. And you could also email me directly if you're interested, maybe in Alabama, or want to chat more about investing in real estate in the Alabama markets. And my email is Candace, and that's CANDACE at astraeq.com. Yep.
Emphasis on the second A, because most people spell it differently, but awesome. And just kind of a shout out. If you're listening to this on a podcast, we do publish these on YouTube as well. So you can go see all of our bright smiling faces soon when we're doing this as well. Makes the podcast much more interesting. All right, Eddie, same question for you. How can listeners learn more about you?
Yeah, you guys can find me on Facebook, Eddie Esparza, and on Instagram, Eddie_Esparza1. And you can also follow a business page on Facebook and Instagram, Epic Property Ventures, one word. And our website is epicpropertyventures.com.
Boom. Easy. Nice when you just take your company name and add a .com on the end, right? So,
perfect.
All right. Well, hey guys, thanks a lot for coming on the show again, to both of you, and very much appreciate your time today.
Thank you.
Yeah,
Pleasure
thank
being
you so
here.
much. It was fun.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.